All right, everyone. Welcome, welcome, welcome. Thank you so much for joining me today. So today we're going to talk about how to create monthly returns using net lease investing. Okay. Um, Before we get started, these types of investments are for accredited and sophisticated investors. So if you are interested in investing in commercial real estate to achieve that passive tax advantaged income, this is not correlated to stocks, bonds, ETFs, crypto, any of that stuff. Set a time to talk with me, right? It's calendly.com/rdyne. You can hit us up there. Of course, go to rdyne.com, rdyne.com. You can also set a time to talk to me or someone from my team. We'll be happy to talk to you about some of our deals that we have cooking and get to know you a little better. If you're on Zoom right now, feel free to go ahead and type in your questions in the chat as we continue going through the webinar here. So, a little disclaimer: this webinar is 100% educational. Okay, this is not an offer, no solicitation here, nothing like that. This is not an offer to buy or sell securities. Any type of security will be fleshed out with the SEC, the Securities Exchange Commission. That's how we do everything. We do everything on the up and up here. And if you are investing in any type of deal, this or anything else for that matter, be sure to consult with your attorney, consult with your CPA, your financial advisor before making any investment decision in anything. Okay, very important that you do that. So let's get started. So what are you going to learn today? So we're going to go through just a handful of things here. We're going to talk about what Bulletproof Cashflow is, just an overview of us, why cash flow matters today, what is a net lease property, what is a fund, and how to learn more about what we're doing. So first of all, let's go through the overview, right? So first about me. So I'm a former C-level tech executive. I used to work with large public and private companies, really on the management side, running large enterprise IT, where I had large staff that did software development, network engineering, network security, things like that. I did that for a very, very, very long time. While I was doing that, I was also doing some real estate before I left all that behind just to focus on real estate. Since then, I'm the founder of two multi-million-dollar companies. We founded Bulletproof Cashflow and Realty Dynamics in 2016. We're based here in Cleveland, Ohio. We have a team of 10 great people that work with us here at the company. We do everything from social media to deal underwriting to property management, the whole nine yards. And we have three primary focus, right? We have three primary areas of focus. We have our multifamily acquisition side. We have our development side, where we do these historical rehabs, and we do ground up developments of assets as well. And of course, net lease. We acquire net lease assets in our fund, and we cash flow them for our investors. So our investment approach is largely demographic driven, systems based approach to selecting our markets and are selecting our targets. So what we like to do is we like to partner with high net worth individuals, with family offices, through joint ventures or even syndication equity, to purchase, optimize, and manage these cash flowing assets over the long term. Now, because my background has largely been technology, we apply a heavy use of technology and automation, from everything from deal sourcing to asset management. One of the key differentiators in our company, anyway, is that we have a lot of technology folks in our team, and we like to use tech to improve the overall investor experience, right? Everything from finding the right asset to having the right technology to allow an investor to see and understand what's going on with that asset, even down to the communication of what's going on. We do value a high degree of transparency when we're putting our deals together. So when it comes to the company, Realty Dynamics, we have a portfolio valued at about $300 million. We have over 1,600 units currently, not including the development stuff, which is close to about 500 units currently under development. We have about 400 plus investors that have invested with us to date, and we have these three separate lines of business that I mentioned to you before. So on the Bulletproof Cashflow side, we have well over 400 shows on our YouTube channel that help investors stay up to date on everything real estate. So if you're into real estate, go ahead and check us out, youtube.com/bulletproof cashflow. If you like what you see, please go ahead, throw up a like, throw up a subscribe. I greatly appreciate it. We have over 5,000 active members in our online communities. We have thousands of hours of content across multiple social media platforms. And of course, we've helped many entrepreneurs through our live events and through the private events as well. So our work has been featured in numerous publications like Business Insider, Forbes, Fox Business. I mean, we've been recognized by many folks with around some of our deals. So now, why does cash flow matter today, right? Now, I think that in case you hadn't heard, inflation is running rampant. Back in January, we had a 39-year high of a 6.2% inflation. Now, what does that mean? That means that we are printing currency into oblivion, right? And what that does to individuals like you and I is that it takes more of these pieces of paper, this currency, to buy more stuff, everyday things that we use, gasoline, food, clothing, whatever. So that's how it impacts our everyday life. So back in January, it was reported by the New York Times here, 6.2% inflation rate, right? Come March, you might have got that 3% raise, but now where are we? We're at 8.5% interest in March of 22. Okay. Do you think it's going to be slowing down? Doubtful. As of yesterday, you see July 13th right there, June inflation soared 9.1%. It's a 40-year high. It is absolutely out of control right now, right? Absolutely out of control. So what do you do in this situation? What happens in this situation? Well, what you have to do is really get a hedge against inflation, which is why net lease properties are that safe haven. They're safe assets that reliably preserve cash flow and give you a nice yield, a nice dependable return with that guaranteed passive hands-off management income, which is what we're looking for. So when you own stocks or bonds or whatever, that value of that stock is tied to a market price that could be impacted by the media. Elon Musk may send out a tweet, next thing you know, that stock price may take a fall, may take a tumble. But the other thing is that you get into these stocks without any cash flow. You can't use leverage. You get no depreciation. It's very different than with real estate. When you're in a net lease asset, you have multiple guarantees that bolster the asset. You get a lease with a strong tenant, with that promise to pay a guaranteed rental income stream, and you get the tangible underlying real estate value that comes along with it. So it's not just the lease, which is guaranteed, but it's the asset that you get along with it. It's part of the real estate. That's part of the asset. It's secured by that. So now let's talk about what a net lease property actually is. Okay, so these are properties, these are businesses that you know and love. Okay, these are properties you drive by every single day. You might have even went to one of these places today, right? There's many more than what I have shown here, but these are properties. These are businesses like AutoZone, Dollar Tree, Dollar General, Aldi, Denny's, Taco Bell. All these different types of businesses are all brands, businesses that you frequent. Now, the cool thing, the interesting thing, is that many of these individual locations are not actually owned by the companies that live there. They are, in fact, owned by individuals like you and I. And these companies that you see in front of you, they lease that area, they lease that space from us. But they also lease them, they're also held by private equity groups, REITs, real estate investment trusts own these. AAA life insurance companies own these types of assets. And the reason why they own these assets is because they're proven to withstand recessions. They're proven to recover very quickly if there is any type of problem. But usually, as we'll talk about during COVID-19 here, there was virtually nothing really happened with any of these assets. As a matter of fact, many of the Dollar Trees and Dollar Generals out there, they thrived. In fact, they thrived during those trying times. It speaks to the long track record of that attractive risk-adjusted return, which is why the REITs, the insurance companies, love these types of assets. But the second reason is, of course, all these assets are backed by that corporate or franchise guarantee that is really one of the key aspects when it comes to these types of properties. So why is it such a desirable investment? Well, as I said, you get these high quality, well-known brands as tenants. And here's some examples that I just threw up here on the screen. You have your CVS, your Walgreens, your Burger King. You'll have your Sunshine House, like a childhood education types of scenario. You have your Family Dollar, Dollar Tree, your medical. These are the types of assets that, again, people frequent on a regular basis. When it comes to overall expenses related to these types of assets, it's usually the tenant that bears the brunt of the expenses. And we'll talk a little bit about that here in a second. But the key aspect, like I said before, is that you have those guaranteed lease. And that means you have those reliable monthly payments, those reliable monthly lease payments that come in. And when you couple that with long-term leases with built-in rent increases that are already defined in the lease that they agree to, it makes for a great asset that builds that predictable cash flow along with a good stable property value that you're also doing when we're underwriting these deals. We look at those sorts of things. And the really interesting part of this is that these types of properties you see in front of you here, they're highly desirable for both the tenants that actually lease the space from you and from future buyers as well. So down the road, when we want to liquidate one of these assets, we've hit our return targets and we really want to sell the asset, this is a great opportunity to do so. And like I said before, all these properties were, at least during the last pandemic anyway, were designated for required businesses, right? So in that regard, all of them were basically open, right? So it tells you that they are resilient against any type of downturn. Another interesting aspect of single tenant net lease is that it is the safest subsector of all asset classes with a consistent occupancy rate of 97%, outpacing everything from apartment to industrial to retail, right? So many people consider these net lease assets as a bond wrapped in real estate, just because of those guaranteed leases. They can count on those guaranteed leases to really make up the returns, right? So we have two primary lease types here. We have double net and triple net. So in a double net, you have the tenant that covers the taxes, insurance, and utilities, and the landlord is responsible for all the structural maintenance and repairs. When a triple net lease, tenants cover all the expenses, including the structural maintenance and the repairs. So the benefits to both is that you get that steady income, you get the little to no expenses, depending on what asset or depending on what lease type it is. You either get that corporate or franchise guarantee, you get these financially stable tenants, and you get a turnkey investment. The key thing to note when you're considering one of these deals, at least what we do anyway, is that brokers will often take an asset and list it as a triple net deal. And when you go through the lease, you find out, well, it's not exactly triple net. There are some other key aspects that need to be looked out for when putting these deals together. So even though it's designated triple net, it's actually a double net, or it may actually be a double net and it's actually not standard, so to speak, where it's not just taxes and insurance, but maybe it's something else that is not usually included in the double net lease. So deep consideration needs to be applied when looking at the leases when it comes to these types of deals. And I mean, this is the type of expertise that we've built over the years, and this is just part of what we do when we're putting these deals together. So these net lease assets are highly desirable, right? People like Marcus and Millichap, Collier, CBRE, some of the largest brokerage houses in the country have said that these types of assets, a single tenant net lease, they smooth out that volatility, they create predictability in a portfolio. They're highly sought after because of that long-term dependable cash flow, right? It's very, very different than other types of assets that it could be a little choppy at times. But the one cool thing about net lease is that no matter what happens, that lease gets paid every single month. And you as an investor can plan on that cash hitting your accounts on those specific days. So let's talk about what a fund actually is. Okay, so our objective, first of all, when we're putting together our funds anyway, is our objective is to acquire, optimizing cash flow, these net lease investments in solid markets across the US have a potential for attractive risk-adjusted returns. Now, before I go on, I want to reiterate something. The risk-adjusted return factor, it's important that we cover that. When I say risk-adjusted return, what I'm referring to is the return of capital with the concept of risk in mind. So if you're going to put $100,000 into a deal that was somewhat risky, you're expecting a high amount of money back because of the level of risk. In the case like this, the risk is low. Because, like I said, you have the corporate guarantee, you're buying the real estate that comes along with it. You're investing along with other people in a fund to acquire great, strong, bigger assets that you couldn't do by yourself. The cool thing is that it's risk adjusted, but it's still a strong return that you'll still be very, very happy with. So generally, how does this work? Well, if you look at the diagram here, so investors, they contribute to the fund and they receive shares in the fund. Okay, the money is pooled together, and with that pool of money, we go off and purchase multiple properties. And the more money the investors contribute to the fund, the more properties we can buy, of course. Now, as the properties generate revenue and they collect their and they fulfill their terms of lease, the money comes back into the fund, and then of course from there we distribute back to the investors depending on the owned shares that they have in the asset. So for the investor, the experience is entirely hands off, right? It's very, very predictable because they know that on the third of every month that cash is going to come in, right? They know it's going to happen, and because they're investing in a fund, you get this greater diversification, which also lowers risk as well, right? So when it comes to these stable markets of single tenant net lease, like I said before, 97% historical occupancy rate across a $2 trillion single tenant net lease market. Huge, right? These are all essential services. What we're usually targeting are these internet resistant types of businesses. Think of businesses that will not get threatened by Amazon or Walmart or anything else like that. And like I said, these are investment grade tenants. These are tenants that are strong and are going to be around for the long term, right? Now, the fund strategy creates these good, nice, strong returns, right? So when we're diversifying across tenants, across industry types like QSR, like food, like education, like retail, you're creating some diversification in the fund itself. And of course, we're not just investing in one area, we're investing nationally. And we get to leverage our real estate industry relationships that we built over the past 17 years to get the best deals we could possibly find. So all this adds up to a risk-adjusted alternative to a fixed income that you might have. So, this inflation hedge that you have in the lease itself is all the rent escalations are included in the leases. It's already defined, right? And you also, so the tenant knows what the lease is, what the escalation is going to look like, and you have the security of the hard asset itself, right? The receivers receive that tax efficient income through depreciation, and they get the interest deduction as well. So they get to enjoy all the other benefits that come along with real estate ownership, right? That depreciation is absolutely huge, and you get that higher income distributions that that beat out the treasury and beat out municipal bonds as well, right? So you get nice, strong returns. Now, some of the other benefits that you get is you have this potential for enhanced returns. Now, as a fund investor, like I said, you're co-investing with other people so allows you to accelerate the returns, meaning you're pooling your money to take down more assets, bigger assets. That diversification then comes in. We're able to participate in multiple assets across several locations and several industries. You also have an IRA option. So if you are investing or you wish to invest with a self-directed IRA, you can do that. So you don't have to have your money trapped in the stock market if you don't want it there, right? The process is very, very simple. You can defer all the gains on your taxes there. So if you don't know what a self-directed IRA is, go ahead and book a call with our staff. Certainly happy to direct you to a self-directed IRA custodian. They can hook you up. They can help you out. Happy to do that. So calendly.com/rdyne, RDYNE, or just go to rdyne.com. That's another thing you can also do there. So you can do that. You get to continue here. So potential for accelerated tax benefits. So the fund investor takes advantage of that bonus depreciation, like I mentioned before. You get all the tax, the huge tax incentives that come with real estate. You also get one of the biggest aspects here is that because we're pooling everything, we're pooling all these different deals together, right? What we usually do is we allocate for each one of these deals, depending on the lease type, we allocate a reserve, right? But when you're buying a bunch of these assets, you can also spread the reserve across 10 or 15 or 20 different assets, right? So this allows, again, for us to even spread the risk when it comes to management of these assets as well. And then finally, you have professional fund management. This is not the first time we've done anything with real estate. We've been in real estate for a very, very, very long time. We have decades of experience when it comes to commercial real estate. So part of this is making sure they have the right team in place when they're putting deals together. So and speaking of that, let's talk a little bit about deal selection. So it does come down to the team first, right? So whenever we're getting our deals together, it's usually the brokers. It usually starts with brokers. We do find a lot of our deals online, but brokers are usually the place to find deals. And if anybody out there, I see a bunch of people on here right now. If you've dealt with multifamily or fairly new to the multifamily space, you know that getting in front of brokers could be somewhat tough without having a track record. Well, the thing is that when you can refer to a $300 million portfolio, brokers tend to listen. So that's that works out better for us. But it's the continuation of building that rapport with brokers to try to get more deal flow. But what we usually do is we partner with the top brokers in that specific area, and we have to maintain communication on a very regular basis with those brokers too, because if you think about it, there's a lot of those deals out there, and a lot of them trade all the time. Okay, our general counsel that we have, they have over 15 years of net lease transaction experience. They're bar registered in all states. We of course make sure there's no conflicts whenever we're working with our attorneys, and they've also been experienced with major brokers around the country. So we prefer to work with experienced general counsel. Now, when it comes to looking at the specific deal, we look at a variety of different things. Everything from population, we do consider that. We look at employment and income. We do give priority to business-friendly areas and business-friendly states. We do look for strong tenant demand. So if there's a bunch of Dollar Generals in one area, this could be an indicator that Obviously, a lot of Dollar Generals are there. What sort of threat lies in with those individual stores? Is there a Walmart nearby? How far is that Walmart? What sort of demographic is living near those stores? These are the types of things that has to be considered when you're looking at these types of deals. But we also look at supply constraints as well, meaning supply in that local area. So if there's many different dollar stores and one of these dollar stores are for sale, it may cause us to raise an eyebrow a little bit, but we're going to dig a little deeper. And what we typically do in that case is we look for, we use data, we use technology to figure out, to get an idea as to what foot traffic is going to that location, right? There's data sources that we have access to that'll tell us how busy a location is, right? And we can see that if it's a busy location, we can't see how much money they're spending, but we can certainly tell that if the place is very, very busy, if the place is very busy, this means that there's a high probability that it's a good store where it's going to make a lot of money, and that store is going to be there for the long term. We do also consider online reviews as well. We look at Yelp, we look at Google reviews, and we look to see how well it reviews overall. And if the reviews are not so good, again, we may consider not to do it, not to do the deal, right? Because it's also an indicator that the people that go there are not very happy with it, and that could be a problem. Another thing we also consider is the exit strategy as well. Like how do we exit this asset? What happens if the place doesn't perform to our expectations? These are all things we consider all up front during just looking at a deal, just evaluating a deal, right? Now, in the way of deal flow, as you'll see here on the right, to go through these deals requires a great amount of effort, to put it lightly. In any given month, we will look at 2,000 screened deals, meaning we look at deals, just look at them, 2,000 of them. That'll lead to maybe 100 deals that we might underwrite. We might get 20 LOIs out, and of those 20s, we might get actually one deal closed. So there is a lot of effort, a great deal of effort that goes into finding that diamond in the rough, so to speak, right? It's a function of the number of assets that are out there. There's just a lot of assets out there, and the more assets there are, the greater work's going to be required to sift through and figure out what deal works best for us and for our investors. So that's where the bulk of the effort takes place. So I'll tell you a little bit about our buying criteria, what we look for. Maybe if you're looking to get into net lease, maybe you look for different things, but this is what we look for. Okay, we look for that freestanding building with a single tenant. We're not looking for duplexes, triplexes, those types of commercial assets. We're looking for a single freestanding building with a single tenant. We're typically looking for 5+ years with an extension. We're looking at for 1990 products, although older properties would be considered depending on how strong the location is. When it comes to the size of the asset, 9 to 10,000 feet is our sweet spot, I guess. If it's a little smaller, if it's a little bigger, we could consider it. Again, depends on the whole deal itself. But generally speaking, that's what we're looking for. When it comes to location, we're trying to find these high visibility, high traffic type of areas, usually with 6+% cap rate. Currently, we're targeting deals between $500,000 to $3 million each, and in the way of security, they're corporate or franchise guarantee. So when it comes to the tenants, we're trying to find a range of these tenants. So they're very specific. These are all, again, they're all strong tenants as well. Like we're looking for automotive service, again, AutoZone, Advanced Auto Parts, widely recognized types of businesses. You have your child education, you have your dollar stores, of course, Dollar Tree, Dollar General, Family Dollar, the usual suspects there. Drug, healthcare, medical, retail. In that way, you could think of Davida, the kidney dialysis types of companies. You have your CVS, your Walgreens. You have your farm, ranch, and garden supply. That could be your Home Depot, Lowe's. Your telecom. Could be your Verizon, your AT&T type store, and even QSR could be considered as well. You have that's when you have your freestanding Pizza Hut, your Burger King, things like that. So as an example here, this is back in 21, but you can see, like, look at this Dollar General market cap, $54 billion, Family Dollar, $9 billion, Dollar Tree, $31 billion. So again, with that whole corporate guarantee scenario that I mentioned before, the likelihood of one of these companies going out of business is very, very slim. The cool thing is that, let's say that Dollar General did go under. They decided, we're shutting our doors and we're going to just go home, right? And they go out of business. Well, the cool thing is that these leases that we own as investors get paid first before even the shareholders do, right? That's how secure these types of assets are. That's how secure they are, right? So, but let's go through a sample asset really quick. I'll show you what some of these assets that we look at, just to give you a flavor of something we might target. Here's an example. So this is a Family Dollar. It's almost $1.7 million with a 7 cap. It's in that, just over that sweet spot, 10,000 square feet. I like that. It's got some nice rent, $118,000. You have these rent increases of 10% in year 2 and year 7. And the real cool thing is they have 6 5-year lease terms. That means that they over when this lease expires, right? Yeah, they can renew this location here up to 6 times, and each time they do, it's a 5-year term, right? It's very nice. And this is located in Atlanta. Again, nice market. It's has 10,000 people in a 1-mile radius. So that means there's a lot of people around this asset. A lot of people frequent this asset, and they spend their money there, and people obviously frequent it and like it. So and all this, by the way, is public information. It's all pulled from an offering memorandum. So there's nothing proprietary here. Continue on to this Family Dollar. This is, again, top ranked national tenant. You have an essential retailer. Very, very important to note here. So I'm not a fortune teller. I don't know if we're going to have another COVID type event again, but you know what? Last time we had one, this store stayed open. They all performed just fine. The dollar stores outperformed all traditional retail, basically, right? It did very, very well. You have these attractive rental increases I mentioned before. You have a strong corporate tenant. In this case, it's an S&P BBB rating. Nice strong tenant. Great location. Less than 10 miles away from downtown Atlanta, and you have a long-term commitment. Right, this is absolutely key with these types of deals. Okay, so just one asset, just this one asset. If you were to buy this asset as just buy it on your own, right? You can expect a nice, healthy return, right? It does very, very well, right? And it's like your cash on cash return 6, 8, and it starts increasing as you go. Right, and that's because you have those rent bumps that are included in there, and you have those renewals as well. But the real power comes in, because it's a fund. What we're talking about is when you blend it, as you blend, like, imagine having 8 of these stores all stacked up, and we buy 8 of these assets. Right now, what are we talking? You're talking about a stronger cash on cash return, and you're talking about a minimum of 1.6 to 2 times your equity. So if you put in 100K, you'll pull out 200. Again, it's a risk-adjusted return, nice and strong, right? And it's going to perform just fine for you, just fine. It's going to be a great asset to get into. And again, you get that monthly check that comes rolling in, right? Same time every month, right? So that's the great thing about these types of assets. So as a summary, right, like I mentioned before, you have a steady monthly income. All right, you have that it's very, very predictable, right? And the third of every month, ACH comes in, check comes in, shows up, right? You can count on it. You have the principal pay down. You have the long-term appreciation, right? Because real estate, generally commercial real estate, depending on how it's bought, appreciates over time. You have those guarantees, those franchise and corporate guarantees that really allows us to, as investors, to really believe that the asset's going to do very, very well over time. And we can, when we're getting ready to exit, there's plenty of buyers out there that are looking for these types of assets, right? Same thing with many other real estate asset classes. You have the numerous tax benefits with depreciation and interest, and you get, especially with this type of deal, you get diversification across multiple assets and across multiple markets. Now, why is it important to do this today? Real estate has proven to be a hedge against inflation because you're taking this paper currency that's basically, they're just printing it to oblivion and you're putting it into a hard asset. That is what you're doing, right? Assets that produce cash are worth a great deal more, okay? Not to mention, when you're putting this currency into these types of assets, you're hedging against any type of future COVID-19 concerns, right? I mean, you still hear rumbling once in a while. You might see someone walking around with a mask, so clearly it's still out there, right? I don't know if it's going to come back or not, but you know what? I sleep very, very well at night knowing that my capital is tied up in real estate. And steady cash flow today matters now more than ever. To know that if you're investing in a fund like this, for instance, right, that if something happens to your job, they decide they don't like your vaccination status, someone decides that they're going to shut down because they're not essential, right? Which has happened to many companies. You lose your income. Well, if you're able to take your capital and invest it in actual cash flowing asset that produces steady cash flow on a monthly basis, it provides you and your family with a great deal of security, is what it does. So if you want to learn more, right, let's talk about learning more about about us and a little bit about preserving cash flow and getting a dependable return. So our team, we've done over $300 million in commercial acquisition and development, right? We have over 17 years of real estate experience. I have many great friends and advisors that we talk to on a very regular basis that allow us to scale and grow. And fortunately, we also have these great lender and broker relationships as well that we've cultivated over the years. One of the hallmarks of our business is that we apply a high degree of technology to filter through our deals and identify the best opportunities we can possibly find. And as I said at the beginning of the call, we are always there for our investors, and having that transparency and communication with our investors is very, very important to us. It's very important to us. So let's go through some NFAQ here. So I put together a list of questions here. So what are the tax benefits? As with other real estate assets, net lease investments, they offer the same tax treatment, right? So the tax benefits include the ability to deduct operating and property expenses before the taxable income, again, depending on if it's double net or triple net. You can also get other deductions to the property as well, like depreciation, or you get the accelerated depreciation through cost segregation. Again, if you don't know what cost segregation is, feel free to reach out to us. If you go to rdine.com, there's a link there. You can just schedule a time. Someone from either myself, someone from our team will reach out to you. Happy to explain what cost seg is, and we can talk a little bit about that. But you also get that bonus depreciation as well, which is also critical. And so what's the next question here? How do I use my self-directed IRA to invest here? Or can I use it? Yes, you can. We have many investors that have invested with us using a self-directed IRA. Some of the wealthiest people in the world, and in the US anyway, use this methodology to invest in these deals. And the reason why is because all those gains that they get come back into the self-directed IRA, all with this deferred tax basis, right? So you're able to take that cash and redeploy it in another asset down the road. So it makes for a very, very powerful way to grow your IRA portfolio. And again, if you don't, if you're not familiar with what a self-directed IRA is or how it works, reach out to the office. Okay, rdyne.com. Reach out, and glad to help you and explain how that works. What reporting should I expect? We deliver status reports and performance reporting on a quarterly basis. Any acquisition or disposition announcements, we do it as they occur. So do we need to be accredited? Our funds are typically open to accredited and non-accredited or sophisticated investors. When will projected returns be distributed? We do that on a monthly basis, as I said earlier. And if you have any questions, of course, contact us. rdyne.com is a great way to get started, and happy to talk to you about how we get it rolling. So again, that's a Calendly link, calendly.com/rdyne, and rdyne.com. Right there is the link. You can also just go there, and if you scroll down, you'll see where we can schedule a time. So looks like we have a handful of questions here. So in the chat, so let's grab some questions here. How do I learn more about investing in your fund? Okay, well, rdyne.com. Go there, and what we'll do is set a time with me or my team, and we will definitely reach out to you. You can also feel free to put your email in the box here, and then what we'll do is we'll also reach out to you there as well. So what does accredited sophisticated mean? Accredited means an investor that is that makes combined income with a household income of $300,000, as well as have $1 million of net worth, not including their home. Sophisticated is someone that is that understands how to do real estate, that understands the risk associated with real estate, but doesn't necessarily meet the income or net worth levels. So that's in a broad sense what those two differentiators are. But I would welcome a phone call from anyone that's interested in learning, going into a little bit more to determine what exactly you are. If you're not sure, again, feel free to reach out, and would love to see how we can help you achieve your financial goals. Okay. So thank you very much for joining this webinar today. Greatly appreciate it. Again, feel free to reach out to us, and look forward to hearing from you soon. Okay. Talk to you soon. Bye now.